Hi, everyone. This is Jason Barrett of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest. He was referred to by my friend Craig Shapiro, another former hedge fund manager. He is also a former hedge fund manager. He is currently a global macro volatility portfolio manager. He went to the Chicago Booth School of Business for MBA and Chartered Financial Analyst, and he has a macro musing Substack that you can take a look at. Dayan, thank you for joining me.
Thanks, Jason. Thanks for having me.
So, Danny, we're recording this interview on Wednesday, November 20th, 2024. The 10 years Treasury yield has started to rise a lot lately. It's up to 4.4%, a little bit above that. The Bitcoin price hit $94,000 today, and the gold price has started to rally as well, above 2,600. First, I want to get your thoughts on the stock market and Fed rate cuts. Are Fed rate cuts normally bullish or bearish for the stock market, like the S&P 500, the general indexes?
Generally, when the Fed is cutting, it's because the economy is weak and it needs support. And that usually means, corporate earnings are, have peaked for the cycle and, ultimately have downside. Typically, the Fed is late to the party in cutting rates. And so usually it's not that great for stocks. It doesn't mean that they immediately sell off on the first rate cut, but usually it's a sign that the economy is, the cycle is mature and has more downside ahead. When they cut in a sort of a soft landing or adjustment cut basis, sort of like 1995, 2019, and then now this time around, it's pretty bullish because, the Fed is telling you, if there's any weakness, we're going to come in, and we have a lot of room to cut. Rates are still at 4.6%. So they still have lots of room to cut. Now, that being said, I believe the Fed is done cutting. And so, this puts me out of consensus on this. But, absent a bad payroll report in a couple weeks, I think they're on pause. And there's a number of reasons that I think so. First of all, when they came in September, it was on the back of a pretty scary, soft job report at the time, as well as a VAR shock that we were getting in markets. And I think these two stories got conflated and mixed together in some way. But the Fed came in with a very aggressive, 50 bips cut to start. Since then, we've had the data that was bad revised better, and we've had good data overall. And we've now had three straight, core CPI prints of 0.3 month over month, which annualizes to 3.6%. And so it really is starting to become clear, something that I've been saying all year, that policy really isn't very restrictive. And the Fed has this, saying or phrase that they consistently say, policy is restrictive. But, just like what you alluded to in your intro, markets are at all-time highs. Bitcoin is flying, high flying, lower quality segments of the equity market are flying, like ARK and things of that nature. The expectation now is that the economy will be very strong under the GOP sweep outcome. So I don't really see a basis for them to cut. They may still do a cut in December, but I think that's dangerous, and I think they should pause.
And you've been tweeting out that the S&P 500, a lot of the companies with the quarterly earnings for Q3, that they've been beating the earnings estimates pretty substantially. So you think that that's justification then for some of the higher stock prices then?
Yeah, look, in general, if earnings are growing, if the economy is growing, and if the economy is strong, the economy is growing above potential, that should be, good for equity prices. The concern really is that valuations are very, very expensive. And, no matter how you look at it, we're at, the second or third richest or most expensive this market has ever been. The 1929 sort of bubble bursting is the biggest one, .com, the next one, and then now. And so, that is a bit of a concern is, buying here, you're buying, future earnings at very rich prices. But that doesn't mean the market has to go down. Valuations are a very poor short-term predictor. It does kind of allude to the fact that when we do have an economic downturn, the move down in the market could be larger than what otherwise may have been due to these valuations. Best case scenario is if we can find a way, which I'm not sure I have conviction on this, but if we can find a way to continue to grow the market, but less than earnings next year and get a little bit of multiple compression, I think that would be very healthy for, the long term of the market. But if we keep, inflating the multiple, at some point it'll be a bubble and then we can have a nasty bursting of that bubble, which would have economic ramifications. So hopefully, some rationality could prevail. But if I'm the Fed and I look at this market, it's hard to say that policy is very restrictive with, how it's performed, not just last year, this year, but also it has very well digested rising bond yields, right? And in the past, a 10-year yield above 4% or four and a quarter tended to hit the market pretty hard. In April, the market went down about 6% when 10s went to 4.7%. In October of last year, we went to 5%. The market went down 10%. We haven't had a correction with respect to rates going from 3.6 to 4.4. So, it tells you that the economy's strong, markets are strong. Hopefully it doesn't inflate into an out of control bubble going forward, though.
Well, I think a lot of the S&P 500 already refinanced at lower rates a number of years ago. So I think, like, to the credit of a lot of chief financial officers of these publicly traded companies, when interest rates were artificially low, they locked in lower rates. They refinanced at much lower rates. They did not wait for the Fed to start raising interest rates. They refinanced before that.
Absolutely. And that's partly why they're not restrictive at these levels and why policy has been mostly ineffective. Is if you think about what the goal of tightening policy from the Fed is, and the long lags thesis that everyone sort of has been pointing out there, the Milton Friedman long lags thesis, is as they raise rates, people don't refinance right away, whether it's a household, whether it's a company, they don't refinance right away. It happens over time. And as those refinancings happen, it eats into discretionary cash flow, or in a business side, free cash flow, to the point where, business decisions like investment or hiring, become uneconomical. And that eventually leads to layoffs. But you nailed it. The fact is, companies were able to term out their debt. It's been very easy to digest higher rates for them as a result. And it just isn't really biting the way rates typically at these levels would be biting. And so that's why I think, the Fed is looking at this from a wrong perspective. And the concern for an equity investor, the concern has to be more than, say, a downturn in the near term, let's say 6 months, next 6 months. The concern has to be a resumption of inflation, right? From the Fed potentially being too dovish. If we have a resumption of inflation, a 4% plus inflation, that would hit the market, in my opinion, because bonds would sell off quite sharply in that context.
Well, I think the stock market isn't the economy, because you have, like, Walmart coming out, the senior executives of Walmart, and they're saying that they're noticing that higher end consumers are trading down. They're getting customers that they never would have had before. So more affluent customers, high end customers are coming in and they're buying from Walmart, whereas they used to buy at higher end places in the past. So I guess the consumer is trading down. They're still consuming, they're trading down, but then you have bad numbers recently from Target. So I think, like, the real economy, there's a lot of evidence there, whether it's auto loan defaults, credit card debt, other stuff, that, like, we have a bifurcated real economy. So people who are have higher have more assets, more income, they're doing well. But people that are, like, lower middle class or working class, they're getting hit with inflation and higher interest rates on their credit cards.
Sure. Unfortunately, that is the nature of the economy. It's a top-heavy economy. The high net worth brackets, the top 30-40% income brackets, are something like 65-70% of consumption. So unfortunately, the way the economy is, constructed or constituted, it is unfortunately the fact that we do have a bifurcated economy. In aggregate, though, when you look at things like debt service payments for households, they're at very, very low levels, some of the lowest levels in history. I mean, 2020 and 2021 are the lowest in history. But other than that, we're at some of the lowest levels in history. So And that includes credit cards, that includes mortgages, it includes car loans. In aggregate, households are not feeling a burden from higher interest rates. Now, what they are complaining about consistently, households, what has been showing up in all the surveys, sentiment surveys and whatnot, is prices, inflation. And so, there's a sense from anecdotal evidence that real world inflation is higher than CPI or PCE are telling you. And you get that consistently when you talk to people, but it's not showing up in the data as much where inflation at, in a three handle is not, inflaming too much, but it does seem like inflation in the real world is higher than what the statistics show.
So why do you think then that we're seeing record amounts of net insider selling by senior executives in the S&P 500, according to the Financial Times with a recent article out this week? And then Warren Buffett, his cash positioning, I mean, he's been selling a lot of shares of Apple, shares of Bank of America. He's going to cash. He's going to US Treasuries. Why do you think that the insiders are net sellers, large net sellers overall in many different sectors and industries in the S&P 500, and then Warren Buffett is allocating capital like that?
I think you have to look at what has happened to the market since October of 2022. It's gone straight up in a very rapid way, in a straight line. I think we were down at 3,500 in the S&P. We're at 6,000, give or take, right now. I mean, this is a very big move, and people want to take some cash or chips off the table. And I think that does make sense. Typically, it's not a good sign to see insider, selling. But a lot of that, to be clear, is typically planned ahead of time. So it's not as if an insider just decides today, I want to sell stock, and they come out today. They have to do a filing, and it takes, months. So these were planned earlier in the year to be executed now. But Warren Buffett is famous about saying he wants to find deals. And, valuations are rich. He's a value investor. There aren't that many value investors really out there anymore, in the institutional space, partly because it hasn't worked in the last 10 or 15 years to be a true value investor. But Warren Buffett still is. And it's hard to say that there's, cheap value in too many places in the market. So, he wants to have his cash pile ready to deploy when there'll be a pullback, and who knows when that is. But that's sort of his approach, and it's notable. But there's no doubt about it that the valuations are very rich, and whether it's insiders or whether it's institutional investors, whether it's retail investors, you should have maybe a little bit of cashing out relative to what a max risk position would be for anyone. So if in October 22 we just had a 25% ish drawdown in the market, and you decide to buy, you should be bigger then than you are now after the run we've had, and I think that's rational.
I want to get your thoughts on the comments that David Einhorn has made, and also Mike Green with the passive investing bubble. Do you think that a lot of this managed money, institutional investors, hedge funds, retail investors like pension fund money, is it going into like the Mag 7 disproportionately with market cap weighting and these index funds, and that you think that that's a permanent trend going forward? Or do you think that this is eventually going to break with the Mag 7, all this capital being allocated to the index funds that are market cap weighted?
I think money goes to where it performs. And so the reason passive investing vehicles have attracted as much flows as they had is because active managers have underperformed. If active managers were outperforming, I think they would be attracting capital, but they have not outperformed in a very long time. Now, Mike Green, who I know well, has a view that it's very difficult for them to outperform, given that in order to outperform, you have to own Mag 7, and to own Mag 7 is essentially just reinforcing this passive flow. It's a very interesting thesis. I don't have high conviction on how this, breaks down, or the financial security stability, I should say, financial stability implications of it. He's much more focused on it than me. but it is undoubtedly a factor in what's driving flows in that 401ks are consistently getting flows as long as people have jobs and they have income. There's some of it goes into 401ks or IRAs and whatnot, and the majority of flows go into passive vehicles, the ETFs. It doesn't go into single names as much as it does into those vehicles. And so it's a top heavy market, and every dollar that goes in, roughly 25% is going to Mag 7. And that's driving things for sure.
You also have like closed-end funds where Chinese retail investors, like institutional investors and retail investors in China, they're paying a 30% premium to net asset value for like a closed-end fund for Mag 7. I interviewed another friend of mine, a former hedge fund manager, Jesse Felder, the Felder Report, and he was talking about this earlier this year. So it sounds like a lot of foreigners, they just view our tech companies, the 6 or 7 largest ones, as superior, and they all want exposure to it now. So it's kind of the greater fool there. They're not looking at valuation. They're just looking at what these are solid companies. They're better than my domestic economy. So a lot of foreigners are buying exposure to our large cap tech companies like that.
Yeah. And, actually, I can actually take this, view a little bit further. When you look at asset allocation overall, not just in equities, but asset allocation wise and across the various asset classes, it's really hard to allocate to any sort of region or country other than the United States. Clearly, the US economy is outperforming the rest of the world. And clearly, US has the best companies. And so the capital is going there. And what used to be a key part of asset allocation has become a riskier, situation is bonds. And so, it becomes a situation where do you hide? And there's so much money out there as a result of how the economy has grown and how much wealth has expanded in this cycle. And with, that capital, where do you put it? You could sit it out in T-bills if you're risk averse for a period or for an extended period, that's certainly a place to be. But as we've seen with bonds, if you bought bonds, in mid-September ahead of a rate cut, you'd be down 4.5%, right? If you bought a 10-year note. So it becomes a situation where do you put your capital? And it's almost as if US equities, I'm not saying this literally, but this is sort of figuratively how it's behaving, are the risk-free asset because they're the best companies, they're stable, they do well, they're continuing to grow, and they continue to outperform. Now, obviously, there's a limit to this. At some point, the rest of the world will get a boost. The rate cuts that they're all doing will stimulate their economies, and maybe that gets a period of outperformance for other markets. But right now, it really doesn't seem like that's in the cards.
Yeah, I was going to bring up the other central banks doing interest rate cutting cycle that they started ahead of the Fed. And it looks like the net liquidity, it ended up in Bitcoin. It ended up in the US Treasury market, buying US Treasuries. What we've seen with some of the data with Canada, France, the United Kingdom, some of the other countries that are large net buyers in US Treasuries, replacing Japan and China, and then also into our Mag 7 company. So it looks like a lot of the net liquidity ended up here in the United States or in Bitcoin or gold.
And that's why the dollar is rampaging. The dollar has been rampaging now for 2 straight months. And part of it is an expectation of, Trump's agenda, his economy, as well as the tariffs that will, certainly be part of his toolkit. And so, that's essentially what we're seeing is a rush or stampede into the US versus some of these other economies.
Now, in terms of Trump, now that Trump has won the election, which sectors or industries do you think will benefit from Trump being in the White House and a Republican or a somewhat majority of Republican Congress, as opposed to the election outcome if it hadn't gone this way? Which sectors or industries do you think will benefit from this?
Well, first, let me kind of break down to you how I look at his agenda, and then we'll talk markets. He really has 5 key pillars to his agenda, and so with the majority win, with the popular vote and the majority, sweep outcome, he's going to implement his agenda. So there's no uncertainty there as it would have been if we had, a divided Congress or if Kamala Harris won, which she was expected to win if she won with a divided Congress. So we don't have that to think about which items can or cannot pass legislation. It becomes more about timing. And so these various policy items that he's going to implement all have different timing. So let's go through the five. Number one is immigration. First things first, he can act on this on day one, and he will, by rolling back any executive actions that President Biden reversed Trump policies when he came into office. Trump will reverse the reversals. And that will slow the migrant situation at the border to effectively a zero, where we won't have that flow of people coming in, which means we will have a slower number of job growth on a month over month basis than we did when we were last year and earlier this year, had a significant supply of labor, coming into the country. But then you have a second aspect of the immigration policy, which will be deportations. And no one really knows how and when that'll play out, but it'll take time to mobilize a force and a policy and figure out who and how you're executing this. But ultimately, this will lead to slower job gains, lower unemployment rate, and a higher wage rate. Overall, a tighter labor market. At this situation. The second aspect is deregulation. And so this will tie into the sector side of things, much more cleaner. But he's very much, there have been a lot of complaints about excessive regulation under the Biden regime, and Trump is very much wants to roll back a lot of regulations. In particular, he wants to roll back regulations on energy and drilling, especially offshore drilling. So he'll do that. That'll be GDP positive in terms of more drilling, more production there. Secondly is the financial sector. And he wants to reduce regs from here. Jamie Dimon, CEO of JP Morgan, did an interview this week, and he said something that I thought was really interesting. He said, bankers are foaming at the mouth at this deregulation agenda, even if they didn't vote for Trump. He said, for every $100 of deposits, used to be you'd have $100 of loans. Now we have $65 of loans. So 35%, fewer loans per $100 worth of deposits. That is a significant reduction. And in fact, the economy's been strong with very little lending going on for the last 18 months since the Silicon Valley Bank situation. So this is something that, will benefit the entire economy, but in particular the financial sector. Now, we've already seen quite a bit of this, right? So we've seen the regional banks go flying, since Trump's odds started rising in, September, October, all the way through the election and through the outcome. But it should be very good for financials overall. As you know, he's pro crypto as well. So from a regulation standpoint, we could see some loosening of regulations there, maybe also some, more codifying policies and an organized policy around crypto that has not existed before. So that should benefit.
Have you seen some of the additional proposals? I mean, they're talking, I don't know if they'll actually do this. They're talking about selling gold and starting a Bitcoin reserve. They're talking about eliminating the capital gains tax on Bitcoin. They're talking about these things. I don't know if they'll actually do them, but they're at least discussing them.
Yeah, they're discussing them, and obviously crypto is flying, as a result. And he's talking about actually having someone in charge of crypto, like an actual, a crypto czar or whatever it will be called in the White House. So, I mean, this is unprecedented around the world. I've been a crypto skeptic myself, and I, always thought that at some point, this is, there's no fundamental value or intrinsic value, and that'll be the story, but it's not going away. And in fact, it's being encouraged, and they're rolling out the red carpet for it. So yeah, it's positive for crypto and crypto related areas. And they're also talking about a Manhattan Project style project for AI to make sure that they have government and private sector working together in a way to do this that protects national security, but also encourages innovation. So all told, I think it's a very pro-business deregulation agenda. Financials should be the cleanest and best outperformer from this aspect of things, but we'll have to see. Then you go to the third item, which is tax cuts. So first of all, they're not going to allow the 2017 tax cuts to expire, which would have raised taxes at the end of 2025. That will be extended. In particular, one provision that Trump, implemented that was very popular is accelerated depreciation schedules. So, typically if I build a data center, let's say, I have to depreciate that, against my, reduce my tax liability via depreciation over many years. Being able to do that accelerated depreciation is a huge tax advantage to saying, let's do whatever investment we were planning 2-3 years from now, let's do it today. And so I think that'll be really benefit, most of the economy, but I think in particular small businesses. And that's why the Russell 2000 and some of these, small cap sectors and things of that nature have been doing very well in anticipation of the election and since the election, and probably will continue. Is they're the most burdened by regulations. They're the most difficult to obtain financing, or the highest cost of financing, and they're the ones that pay the highest taxes. So that will benefit small caps in general. And then you have the fourth sort of item is tariffs. This is something where it is going to have an immediate impact, and it will have a potentially a longer term impact. And this is going to be really challenging, I think, for assessing the impact. He'll come in and impose tariffs right away. Now, I think the tariffs will be different than the 2018 example. And I think people are applying too much of that as the parallel here and saying, let's look at the economic impact in 2018 and saying, GDP took a step down and inflation didn't go up in 2018. Well, first of all, we had a very different economy back then. We had, a deficit of demand. We basically had a dearth of demand. We now have excess demand. It's a very different economy. Secondly, we had a lot of uncertainty about tariffs due to the fact that they had only been going down for 60, 80 years, and they had not been part of the toolkit. And it was a lot of uncertainty for businesses to understand, what's going on here? Is this permanent? Is this going to affect my supply chains? Do I have to change my supply chains? I think that uncertainty is gone. Everyone knows that tariffs are going to be actively implemented. And I believe companies are actively making preparations for that now. So second, and then last point on this. So I think it's less negative for GDP, for investments and that side of things. But I think it's more inflationary. And the reason I think it's more inflationary, it was inflationary in 2018 for the specific categories of goods that tariffs were imposed on, but those weren't the dominant parts of the consumption basket. So it didn't, overall raise overall inflation too much. But this time around, we're talking about blanket 40 to 60% tariffs on everything coming in from China. And that's excluding potentially other countries as well. And so when you look at the world we're in now, companies have less of a stigma of passing input costs onto the end consumers. That stigma existed in the last decade, where companies thought, if I try to raise prices, I'll lose market share. There's no longer that stigma about doing so. So I believe they will pass these through right away. And so it'll be inflationary, at least initially. It doesn't need to be permanently inflationary. It'll depend on the response of the opposing countries, as well as the response of the business sector. So, for example, if other countries' currencies, were to weaken 1-for-1 with the tariffs, then there's no inflation, right? So let's just say the Chinese yuan, if it were to weaken 40% for 40% tariffs, there's no inflation. That equalizes the price change out there. But realistically, China is not going to allow their currency to weaken as much as the tariffs, so it is likely to be inflationary. However, when we look at the ultimate goal of tariffs from Mr. Trump's perspective, it is to bring investment into the United States called onshoring. So I can use an example. If you're China, and China's become, and we'll just use one sector, China has become one of the dominant, auto production countries and exporters in the world, in particular in electric vehicles. Their BYD company is, considered the biggest seller of electric vehicles around the world now. And I've never had the pleasure of seeing their cars, but everyone says good things about them. And they are exporting them around the world, not so much into the United States. But if China, wants to not be tariffed, they can easily bring, their manufacturing prowess and build a plant in, say, Michigan. And if they build a plant in Michigan and hire people there, obviously that's GDP positive for the US in terms of investment in plant and equipment and investment in people, and you avoid tariffs. So it doesn't have to be inflationary
Well,
if you get the desired outcomes that Mr. Trump wants, but remains to be seen how it plays out.
Yeah, I agree. It's too early to tell right now, but I think like any tariffs that Trump puts on, any additional tariffs is kind of already just accelerating the trend, because you have the tariffs that Trump put on prior to the pandemic, and then the Biden administration kept a lot of those tariffs on. But then also during the pandemic, you had a lot of companies, they started switching their supply chains. They saw that there was all these restrictions for exporting goods out of China. So they started moving their just-in-time supply chains. They started building factories in India, Bangladesh, Mexico. They started moving more factories already. Now that if it's closer to the US, you're in Mexico, you have NAFTA and stuff like that. But I mean, that is still probably relatively higher cost for importing, even though it's in Mexico. So the costs are going to go up, but it diversifies the supply chain. So I think that trend was already happening. And if Trump puts on additional tariffs, that trend's just going to be accelerated then.
Yeah, and here's my optimistic take on all that. I agree with everything you said. My optimistic take on that is, again, in 2018 when he did this, he was already halfway through his term. They had the midterms, and businesses were completely in shock at the tariff policy. Even though he talked about it, no one actually thought he would do it, and he did start doing it. And businesses were in shock, and they were inexperienced at shuffling their supply chains. And as a result of both 2018 and COVID, businesses are far more familiar with moving around their supply chains, diversifying their supply chains. And so now that we had tariffs in 2018 and Biden, like you said, kept them on, and then now that it's going to be implemented from day one in a more expansive way, businesses have to start looking at it and say, this is a new permanent regime. Let's stop thinking like this goes away in a few years. No, we have to start thinking that this is a permanent regime. So we may get more onshoring this time around than we got last time. And we may get more diversification away from China to the economies you mentioned, like Vietnam, Mexico, and others as well.
India is booming now. I mean,
India is
just to handle all the manufacturers and the factories moving there. I mean, they're talking about insane amounts of infrastructure, nuclear power plants, coal-fired power plants. I mean, they're trying to buy up all the energy they can right now.
India is a very exciting economy for the next, decade. Absolutely. And I think you kind of mentioned it, but Mexico can be a bridge between the tariff wars, for maybe not for China, because I know Trump doesn't want China to sidestep tariffs going through Mexico. But if you're, let's just say, a German, car company, and you want to move your production to avoid tariffs, let's just say BMW, to avoid, tariffs. Either you build another plant in the US. They have manufacturing plants in the US, but they can move another one, build another one, or they can move to Mexico, which is tariff free with the US. It'll be, like you said, a little bit more expensive, potentially, but you have, logistics of shipping goods is far easier from Mexico than it is, going through across the ocean. And so I think, I'm trying to take the optimistic side on this, in that it won't be as bad for GDP, and the inflationary impacts might be temporary, but temporary could be a long time. And it could take time for these factors to play out, all these things, dynamics that we just said to play out. And the real concern is that we are already at 4 years of elevated inflation. Even if it's just a temporary bump in inflation, the Fed will have to react to it. So last time around, if we had 2%, CPI and tariffs took us to 2.5, you can ignore that. We had a decade of low inflation. We get a bump up. You don't need to hike rates in response to that. You ignore it. But in this case, we've had 4 years of elevated inflation. People are very sensitive to it. Imagine we get a temporary boost to 4.5% inflation. There's no way the Fed could sit back and not do something about it. And so, that'll have to be part of the calculus here is, does the Fed get hawkish again in response to this? And we'll have to see.
For the other sectors, for Trump and a Republican majority in both houses of Congress, are you looking at maybe enforcement of the rule of law, like these publicly traded prison stocks? I'm not in favor of throwing lots more people in prison, but if they're going to adhere to the laws, it sounds like a lot more people for committing armed robbery, felony stuff, they're going to end up in prison. Liquefied natural gas export facilities. Do you think Trump's going to maybe offer some subsidized loans, and we're going to? I think we're already number one or number two for liquefied natural gas exports. Do you think then by the end of his term here that we're going to be clear number one for liquefied natural gas exports once he opens up the permitting, the drilling on the federal lands, in New Mexico, build pipelines, and then we're going to be the clear leaders for liquefied natural gas exports? Do you think those industries are some of the top ones, or another one like infrastructure?
Well, the entire energy sector is going to have a huge amount of demand going forward, whether Trump won or not, due to AI, due to crypto, due to all these things that are very power intensive. And so already the electric grid, whether it's, and then nat gas is obviously a clean source of energy. Nuclear is being talked about a lot. All of these areas certainly, are going to be crucial going forward. So it's good that we get a deregulation agenda. But in particular, since Trump won, within a few days, the EU trade commissioner came out and said, we should be buying nat gas from the US, not from Russia. Right. And so I think you will see, from that perspective, a lot of countries say, let's buy things from the US so that we can stay out of the crosshairs of trade wars. Right. And so I definitely think nat gas is an exciting sector, for that. Prison stocks, I don't have high conviction on. I think what you're saying is an interesting story and worth looking into. I do also think defense spending needs to increase, and that is an area where it's a volatile world right now in the geopolitical world. We've had a number of conflicts, obviously Ukraine, and then Israel and Hamas. And as well, got carried into Lebanon and as well Iran. North Korea is starting to get active again. There's the risk of China making a move on Taiwan, which is always in the back of everyone's mind. We are in an era of increased conflict. Now, let's hope that having, a president, more forceful on these areas can prevent these conflicts from occurring. Remains to be seen. But I do think the military and spending needs to increase, at least at a minimum, to replenish all the ammunition stockpiles that have been given to Ukraine and Israel and whatnot, and Taiwan. And so, at a minimum, there's that. But there's also a lot of modernization of things like hypersonic weapons, adapting to new forms of combat, things of that nature that require substantial investments. So I think the defense sector is another good one if you're like a long-term investor over the course of the next coming years. Prison stocks are interesting. I don't have a high conviction. Like I said, I think it's worth looking into though.
Yeah, I think also maybe infrastructure stocks for like steel and copper, because like it seems I've lived right outside of Washington, D.C. for almost 25 years now, and it seems like an infrastructure bill is passed every couple years, but then we don't fix the bridges. We don't fix all the key infrastructure stuff that needs to get fixed. That stuff has to get fixed immediately. I mean, we just see so many roads and bridges and dams breaking down. The stuff needs to get fixed. It needs to get upgraded. Trump is good at building things with a lot of his buildings, so maybe he will, the Department of Government Efficiency or someone will be able to get some of these construction projects through and we'll actually get better infrastructure, and then what that would benefit the infrastructure companies in the US.
It hasn't been his biggest priority in terms of talking about it. I've been on the infrastructure argument. I've been making the same argument that you just made for over 10 years, that the infrastructure is really, really worn out in the United States. I mean, LaGuardia Airport, I lived in New York for 15 years. LaGuardia Airport was always horrific, JFK, Newark, and those are just examples. But the bridges, the tunnels, and we did have a bridge that fell a year ago or 2 years ago that collapsed, right? I think it's a sign that needs to be invested in. But not just that, I think also logistics infrastructure, such as like air traffic control, where flights are routinely delayed on a regular basis because of air traffic control just being overwhelmed. That needs to be modernized. I just don't know how much, with such a full agenda, if he prioritizes this as much as I'd like. But we'll have to see. The Biden agenda did pass that infrastructure bill, and that infrastructure bill has been positive for the economy. It's a big reason why we've had significant investments in data centers. Non-residential construction is like through the roof. It's exploded higher. That's been something that's definitely been supportive of the economy. I hope he keeps it rather than cuts it. Sometimes presidents want to just cut anything their predecessor did out of principle. I hope he keeps this and focuses on it like you're describing, but I don't know. I don't have high conviction on that.
So you talked about inflation, and I think that was one of the top one or two issues for American voters in the last election here and over the last couple weeks. And then also rising bond yields. Do you think that this higher price levels, inflation, do you think that that's why a lot of foreign central banks, along with the Russia sanctions in early 2022, these non-G7 central banks, they're seeing inflation. They're seeing the spending from both political parties in DC. And do you think that that's why they're not large net buyers of treasuries, and that's why they're buying gold tonnage each month at an increasing rate instead of treasuries?
Yeah, I mean, I think there's a lot to unpack here, but obviously countries like Russia and China are very focused on diversifying away from the US dollar due to potential sanction risk on any, in the event of any sort of geopolitical action. So there's no doubt about that. But other reserve managers are also looking at this world and saying, this is a inflationary world, right? Things have changed, and it's multiple years in a row where the bond market is delivering losses. And that's something that nobody was really used to for, decades. Bonds were the perfect reserve asset. And, they still are a good reserve asset, and reserve managers are able to hold bonds to maturity. So it's not as if they're going to lose money on a terminal value basis. But we are seeing migration away from treasuries to gold and things like that pick up. And I think, gold does well in certain regimes. In certain regimes, it doesn't do well. And in other regimes, it goes sideways. The regime where it doesn't do well is where you have, hawkish central banks that are actively tightening policy. But in the world that we're in, where you have loose fiscal and a Fed that is just almost permanently dovish, that's when, and at a point where it may be very inappropriate for them to be that way. That's why gold is flying. I think gold basically all year sniffed out that, we're going to be reflating back to a higher level of inflation again, that, the disinflation will be ending and we'll be having more inflation. I think that's a big reason why gold's had the run it's had this year. And, everything I see tells me that inflation will remain sticky and potentially have some upside. Doesn't mean 8%. We probably won't see that again, but the Trump agenda to me looks like it's GDP positive, will encourage animal spirits in the economy via deregulation, tax cuts, lending, potentially picking up would be very healthy. All of these things tell me that doesn't make me think inflation is going to, continue disinflating here. And frankly, it's been stuck above 3%. Core inflation is stuck above 3% and really isn't making much progress anymore. I think that's certainly an issue, and it'll have to change the calculus for the Fed if we have a stronger economy, and for all the reasons we mentioned, that will keep inflation, elevated, and so the Fed will have to at least be on pause for longer, pause cuts, and see how this plays out. Be more open-minded, or more two-way on their policy set.
Well, I think a lot of the gold and silver demand, Danny, I think it started outside the United States. It started about 12 months ago in China and a lot of other emerging markets because their central banks started to cut interest rates faster, adding net liquidity because the Fed was keeping rates higher. And then you had all this liquidity flow was either going into Mag 7 or into gold.
Yes. I mean, China for the first, 7, 8 months was buying every single month large quantities of gold for their reserves. In the last few months, they've actually haven't. So that's interesting. But again, I think it is something where they want to diversify away from just US dollar assets. And it makes sense. It makes sense for them to do it. And gold is physical asset, it's tangible physical asset. It's a store of value for many centuries. It's a long history. And so I think, it does suit the needs of central banks to be able to manage their reserves and not just be all in treasuries. And the fact is, when you look at bond markets around the world, there really aren't any bond markets except for the US, Germany, a little, and the UK that can handle large size in terms of bond flows. Really, those are the three biggest. Japan as well, but there's very little yield there. And so, when you look at these bond markets and you say, either I have to go into treasuries if I have, multiple billions to do, or I'm going to diversify and own some gold and maybe equities too.
Well, doesn't the Bank of Japan, they own like a large chunk of Japanese exchange traded funds for their stock market, and also like a large chunk, like over 50%, I want to say, of the Japanese government bond market is owned by the Bank of Japan and their pension funds. So there's a disproportionate amount. That's why you have these economists say Japan owes the debt to themselves. It's no big deal. That's what they claim, at least.
Yeah, I've always looked at, everyone talks about Japan debt to GDP, 250%, give or take. I've always adjusted it for the central bank holdings because I assume that the Bank of Japan will never sell it. And in fact, if we look at, there's been a ton of QE across the world, not just the US. Obviously, Bank of Japan was actually the biggest. Eurozone was pretty large, and then the Fed, UK, Canada, other countries as well. But other than the UK, no central bank has done sales of their bond holdings. They've all just done what we call the roll-off. So QT is basically just letting expiring bonds go off the balance sheet. And that's the way that the balance sheet has kind of been shrinking. And so if you actually, you take that assumption further, you can assume Japan is not going to be selling bonds anytime soon or ever. And so as a result, the debt to GDP, a lot of it's been monetized, and a lot of it is owned by the Bank of Japan, is taken out of the system. So really, debt to GDP is more like 150% than 250 from that context.
A couple more questions before I let you go. As a global macro volatility portfolio manager, are you surprised that there's more bond market volatility in the US Treasury market than there is in stock market volatility?
I have been surprised at equity vol being as low as it has been. There were obviously pockets where we did get, more vol, but in general, I think this is an uncertain world for growth, for inflation, for policy decision making. I would have thought equity vol would be higher. I do think bond vol being up here makes sense, and a lot of people have called for it to come down. I'm not in that camp because I could see a case where the Fed comes in next year and continues cutting rates, or I could see a case where they're on hold the entire year, or I could see a case where they actually may need to turn around and hike if the economy does take a leg up. And when you have that type of uncertainty, volatility should be higher. But even just forgetting about the policy rate, we had a 10-year yield that started the year 3.7, went to 4.7 by April. By August, went to 3.6 in August, September, and is now 4.4. These are
Roller
big moves.
coaster. Yeah, roller coaster.
These are very large moves. I can tell you that when I traded bonds from 2010 through 2019, we very rarely saw like 20 bip moves ever, over the course of a month. You didn't get these big swings. You would get like 1 or 2 basis points moves a day. At one point when I was on the sell side, I remember someone asked me, what did bonds do today? I'm like, they did absolutely nothing. I don't have anything to add here.
Well, if they move like that with a lot of hedge funds and bank portfolio managers putting on what risk parity with lots of leverage, borrowing from the repo market, I mean, wouldn't more hedge funds have blown up then? There would have been like lots of Archegoses or other like hedge funds needing bailouts or going bankrupt.
Well, okay. The big thing, obviously, the bond market has faced steep losses of 25+%, since 2020. But you have to remember, the Fed owns a significant amount of bonds, and they were buying, roughly 4 to 5 trillion from 2020 through the beginning of 2022. And that amount of bonds has shielded the private sector from losses. Because the Fed's losses, which sometimes you see those charts that show losses on the Fed's balance sheet, but they don't have to, mark to market their portfolio. Like they can have that loss and hold it forever until they get repaid par on the bond. But if the private sector had to hold that, all of a sudden your equity wealth that you've made from the market going sharply higher would be somewhat tempered by losses on whatever bonds you own. Right.
So Silicon Valley Bank, yeah, they can't hold all their bonds to maturity. They started a bank run, and then they had the losses on the bonds. I think even a Federal Reserve Bank presentation posted that Silicon Valley Bank had all these losses on their older treasury bonds.
And I mean, banks still have those losses. Bank of America is, kind of the biggest one. It's not a danger zone for them by any means. I'm not sounding alarms here. The hold to maturity bucket, has purpose as long as it's managed, with sufficient capital on the balance sheet and, whatnot. It's not necessarily a concern, but banks as well, in 2021, there was a regulatory change by the Fed that effectively from COVID, banks were exempted from certain regulations because they wanted the banks to be part of the solution this cycle. With COVID, they came in relatively healthy, unlike the GFC. And so they could be part of the solution for the economy by lending to the private sector beyond what their regulatory situation would have allowed them to do. And then that exemption expired in March of 2021. It was called the SLR exemption, supplementary lending ratio. And when that happened, it actually meant banks were constrained from certain activities. As a result, they had no choice but to buy a ton of bonds that year, which is what led to the Silicon Valley and other banking sector issues, is the bonds that they were buying in 2021. And so, again, those bonds, other than that, episode of the Silicon Valley Bank and regional bank crisis for, 2-month period, those bonds have been taken off the private sector's hands as well, right? Like the household sector, hedge funds, pension funds, none of them have had to buy the bonds that the Fed did and have had to buy the bonds that the banks did. If not, we would be looking at a less exciting wealth situation, household wealth and business wealth, essentially, if these bonds, the losses were worn by the private sector. But the fact that they've been kind of put into a box and kind of just put away into a corner, never to be touched again, it has saved a lot of the industry from those losses. And so that's a big factor that I don't think people appreciate too much.
Yeah, you also had in 2020 and 2021 the government sending out what stimulus checks. So when people got a paper check or was direct deposited, then the banks they're not just going to hold the reserves. They're normally going to either give out loans or they're going to go buy treasuries. So they're not just going to hold the cash in reserve. They're going to go park it into something. Either the loan book's going to grow or they're going to go buy treasuries. So that's
Yeah,
what
and
happened with the stimmy checks. Is the government was like, oh, we're going to stimulate demand. They give out stimmy checks, right? And then Silicon Valley Bank gets this flush of cash, right, depositor cash, and then they go and buy those low yielding US Treasury bonds. And then when the Fed raises interest rates, that hurts the bank.
yeah, we give the banks a lot of flack for this, but look, their decision process was in 2021, like you said, they get flooded with reserves. What do they do with those reserves? They can park them at the Fed and earn zero because policy rates were zero, or they can buy 1.5%, 10-year bonds and at least earn something. And, I think this is a stupid decision in hindsight. And even in real time, I would have told them not to do it if they asked me, because I mean, at the time in 2021, the economy was roaring ahead. Inflation was picking up. We didn't know it would get to 9%, but it was still a very strong economy, and you're buying bonds at yields that don't really make any sense. But at the same time, the Fed was telling at that point, hey, we're not hiking till 2024, and even then, it'll be a gradual hiking cycle. The Fed's mindset was still in like the 2010 sort of world, right? And a GFC type of world. And so, banks took their cues from the Fed. So the Fed deserves a lot of that blame. Now, Silicon Valley Bank and a few other banks, really just poorly managed their balance sheet. Like, for example, I told you Bank of America bought a ton of bonds. And sure, they're facing unrealized losses on their hold to maturity portfolio, but it's not to the point where they're unable to conduct their business or they're worried about deposits fleeing them in mass and that leading to liquidity issues for them. No, because they manage their balance sheet better than Silicon Valley did, which Silicon Valley, not only bought a ton of bonds, but their liability stream was, frankly, very concentrated in one particular part of the country, Silicon Valley area, the VC tech sector, to the point where they were susceptible to bank runs. And so you had all of these things that were just poor management decisions. But the big overarching decision was the Fed and the regulatory regime changing and, the guidance that the Fed gave. And these banks all made those decisions. But you know what? There are good banks out there. JP Morgan, Jamie Dimon infamously said, I'm not buying bonds at these yields. And he didn't. And they didn't load up on bonds at these yields. And as a result, they avoided that hold to maturity portfolio issue entirely. That's why their balance sheet is, rock solid.
Last question before I let you go. Are you making long-term investments in this type of macro environment with the policies? And by long-term, I mean a couple years out. Or do you think that this is not a good environment to be thinking 1, 2, 3 years out in terms of like, I'm looking at cheap undervalued sectors where there's growth potential, things could change in 6 to 12 months, and I'm going to buy some cheap, good small cap companies or mid-tier companies that are cheap and hated, but they have good growth prospects and things can turn around?
I'm not doing too much long term, at this juncture. I would say the areas that I'm looking at for long term would be the nat gas sector, like we talked about. I think that's a long-term story that you can hold for multiple years. The defense sector, I think, as well, is a sector you can hold for a long term. I'm also looking at certain regions around the world where a lot of markets have gotten beaten up. And I'm not saying today, but for example, Mexico has gotten beaten up pretty badly this year. I think that's still a good economy to own. And I haven't bought yet, but I think there will be a time to buy there. I think China is very, very cheap. And so, the expectation, at least from my perspective, is especially with tariffs coming, they are going to have to do the big stimulus that everyone's been kind of wondering, are they going to do, not do? They're going to have to do something. So I think, Chinese market could have upside. And another market, that I'm focused on as well, in the Trump regime is Israel and the Middle East. I think it's this has been a tough region to invest in for a very long time. Israel's been the only democracy in that region for a very long time, and they have, efficient capital markets and a very nice tech sector. But you always had the instability in the region. Clearly, we've seen that in the last 13 months, instability in the region and conflict in the region due to the Hamas attacks on Israel, due to Hezbollah, due to, Iran. But Trump is a very pro-Israel president. He's going to allow Israel to finish the job in Hamas and Hezbollah, which they are almost done. And I think once we get through that, if Iran is, dealt with in some sort of fashion where, either nuclear is eliminated, or even more so if there's regime change from, the IRGC regime that supports terrorism around the world, the Middle East could all of a sudden be one of the more exciting regions in the world from my perspective over the coming years. You could have the potential with a peace arrangement or a normalization of ties between Israel and Saudi Arabia. So when you look at the Nasdaq, which is, well over 30 times forward earnings PE in the US, being able to buy the Israeli tech sector at an 11 PE in what may have a region that has been, a very poor investment region other than Israel could now have a material change to the status quo. I think that is a very impressive, region to be invested in. And India is one that, it's going through. It got overbought. It got too expensive. It's going through some correction now. But I think India is another long-term story. Mexico is another long-term story, and Israel is another long-term story. These are the ones that I think have, substantial upside, coming in coming years.
As a generalist hedge fund manager, I want your view on gold stocks because we're at over $2,600 an ounce gold. The gold price seems to be holding up really well. I mean, it was correcting the last couple weeks, and now it's just started to rally again. Do you think that these gold companies, I don't know if it's Newmont Mining or Barrick, that they're miners, but there's royalty companies too that you don't have to worry about the oil price or labor costs or some of the other ridiculous costs that seem to always go up? Do you think that they're going to actually start making money, or as a generalist investor, are these companies just routinely disappoint with the earnings?
They just routinely disappoint. So I don't have an edge here. There are people who focus on this much closer than I do. I remain skeptical that if they have not been generating earnings in the last 2 years, when will they? Right. So why would I bet that they will going forward when a lot of the good news may already be in the metal now? We don't know. There's probably still is more upside to gold and to silver. But if you're looking at it, from this perspective, if they haven't generated earnings in this 4-year period,
Oh, you mean
when,
earnings growth where like the
yeah,
gold price went from like 1800 a year ago, around 1800, it was in correction mode and people like panicking, right? And then over the
yeah.
last 12 months, it's 1800 and it hit 2700. You'd think that the earnings and the free cash flow, the profit margins would be good, but we've seen disappointment from Newmont Mining.
Right. And so if it's to have disappointment now, why should I expect that to change? And so I don't, I prefer investing in the metals themselves, trading the metals themselves, which is a cleaner expression of that thesis than the miners per se, where it just seems they always disappoint.
Well, it's mostly Newmont Mining. I mean, some of the mid-tier gold miners, they're actually maintaining profit margins, free cash flow. So it's really like the big ones. So if you're a large money manager and you can't afford to allocate to a smaller gold company with like a 10 billion market cap or a couple billion market cap, and you're looking at Newmont or Barrick Gold. I mean, these companies as proxies are bad proxies because Newmont, like the earnings are just not, they're not maintaining profit margins and free cash flow like you expect. But the other gold companies, for people who are not large money managers, there's opportunity there because they actually are having good earnings. So I think like there's kind of sometimes it benefits like the retail investor because if you're managing tens of billions of dollars as a pension fund or a institutional investor, you can't allocate capital and move the needle.
Yeah, I think that's fair. And look, if you have a long-term perspective, I don't want to discourage you from, potentially investing in this space, but from my perspective, I tend to focus where I have conviction, and I don't have conviction that these miners will be outperforming the metal itself. And so if they're not going to outperform the metal itself, I'd rather just focus my bullets on the metals themselves, because I wouldn't do both. And so, as I pick and choose where to allocate, I would prefer to be exposed to the metals themselves. And in fact, I did last week buy upside on gold. I mostly trade, via options. And I liked that we got an 8%, give or take correction, because it was a little euphoric. It was very overbought. It was basically people were putting out thesis that it's bulletproof. Nothing can go wrong. Buy gold with your eyes closed. And whenever I hear things like that, I'm always, more cautious. And then we get a pretty solid correction that wipes out a lot of that positioning. I came in last week and I put on a multi-month upside trade that, I'm going to ride for now. Obviously take profits along the way, but we'll see. For now, I think we can definitely make a move back to 2,800, and then we'll see from there. But I think there's momentum back to the upside on gold, and silver is interesting because silver tends to lag behind gold for a long time, and then gets a period where it just explodes higher. We did get that earlier where we went to like $34 in silver, but then it fell back. And so now gold is leading again. Think today gold was up, silver was down close to 1%. So, we'll have to see if silver ever gets its time in the sun, really. It had a fake breakout that, it kind of gave back. So we'll see on that. But I prefer to just stick to the metals. For me, that's where I have conviction.
And the first Trump administration, regardless of like his tax cuts and the economy improving, I think the gold price ended up in about his 4 years or over 30% increase in the gold price in US dollars. So someone put out a chart in the last couple weeks showing that the average person, I don't know, forgets things. They have selective memory or confirmation bias. They just don't go back and look that like with Trump's policies and all the stuff he's implementing, and the stuff is going to be probably similar to the first administration. Maybe he's more efficient, but it was still good for the gold price there. It still looks to me like he's going to be running budget deficits.
Yeah, I'm not a big I'm not a big believer in this sort of Department of Government Efficiency being here to
well,
to
well,
save the day. I'm
it
skeptical on
it
it.
sounds good. It sounds good, but like I've lived here, Danny, for almost 25 years, and I could tell you that like if you cut like the budget for one government agency, like they just wait for the next congressional midterms, or they wait 4 years to whoever another party's in the White House, they just wait it out, and then they go right back to whatever was cut or eliminated.
Yeah, and first of all, this department won't have authority to cut spending. They'll have to go through Congress. So, first of all, our expectation should be that whatever they discover will only be presented to Congress in terms of a budget in the end of 2025 to be implemented for 2026. So everyone who's expecting, big, bold results should temper that enthusiasm in terms of timing, at least. Now, who am I to question Elon Musk? This guy is, if you underestimate him, you get your behind handed to you, is pretty much the story throughout, his life. But the thing I would say is if you break down the budget to discretionary spending versus non-discretionary spending, mandatory spending, there's very little discretionary spending. And so, you can actually break it down to something like 700 billion of discretionary spending. And if Elon Musk is as good as he is with cutting expenses in Twitter and Tesla and other places where he's done so, at doing it for the government, what are we looking at? Maybe they can cut 300 billion if we're being very generous. From that 700, you cut it to 300, 350, cut it in half, let's say. That's if that's the case, they should do it. They should pursue that. We need that. But at the same time, interest expense is growing over $1 trillion a year now, right? And
I'm
so
skeptical, and it seems that like the Republicans want to increase on defense spending and upgrade technology. I'm seeing all these research reports out about that with different estimates between 1.8 trillion in technology, military defense spending upgrades. I've even seen 10 trillion estimates for like hypersonic missiles and drone technology and building data centers for artificial intelligence and stuff.
yeah, and tax cuts. He wants to do further tax cuts. Now, certainly, all the things he kind of threw out there are probably not going to happen. Not all of them, at least, but that is what he's talking about. And more importantly, if I have a fairly high conviction that Trump is not someone who's going to put up with a weak economy in his term in order to get benefits that will extend, 20, 30 years from now. He wants the economy to be hot during his term. And, he's of that view. So I just don't see him doing enough cuts that would really move the needle because they would also hurt growth substantially. And I don't see that. But let's hope that Elon Musk, goes in and department by department and trims enough fat that it helps because the debt situation is very scary. It's very elevated, and it looks like it will be for time to come. And more importantly, no one talks about this at all. By 2028, 2030, Social Security becomes in deficit. So that's another 5, 6 trillion of off balance sheet, liabilities that come on balance sheet because there's no way that Congress is not going to bail that out. You're not going to strip benefits from seniors who've already contributed to the plan, right? And who
Yeah.
rely on it. A lot of people rely on Social Security. If you're in a lower income bracket, Social Security can be 30 to 50% of your income. And so, I just don't see that being politically feasible. And no one's talking about that because that bill is going to come due in a few years. And so, whatever we're talking about in terms of cuts is going to be de minimis compared to that.
Well,
Uh,
also, if there's a recession or a banking crisis, commercial real estate problems going forward in the next year or two, I could see Trump pressuring the Federal Reserve Bank to start massive amounts of rate cuts back closer to zero interest rate policy, some type of stimulus or quantitative easing programs. I could see Trump pressuring whoever's running the Federal Reserve Bank at that point into that stuff if there is a recession
if there's a
officially.
recession, I don't think you need the Trump to pressure the Fed. The Fed is very dovish as it is. They want to cut. The reason they're going to potentially pause in December is because the data is too strong and the markets are telling them they have to cut. The markets have rejected their rate cuts. And I think that's a very important message. The bond market is telling them you're overdoing it, stop. And so they'll probably stop either in December or shortly thereafter when the Trump agenda is clear. But the Fed wants to cut. So believe me, if the economy is weak, if we had a job loss cycle and a negative GDP, period, the Fed would be more than happy to cut aggressively. They would do it without any hesitation. And so I don't think he'll need to pressure that. The concern that people had in the political, debates before the election is that he would push them to cut rates when it's not appropriate. And I don't believe that to be true. First of all, Mr. Trump, was around in the 80s and 90s when the economy was just fine at these levels of rates. If the economy's strong, if markets are strong, I don't think he's pushing for any changes, But if the economy is weak and the Fed is holding, rates in their hands in their pockets, yeah, he's going to pressure them. But in general, I just think otherwise, they would be very quick to cut in that context. The fact that they were aggressively cutting in September at a 4.2% unemployment rate tells you all you need to know about this Fed. They want to cut, and they won't need an excuse if the economy is weak.
Yeah, no Paul Volcker's out there. I mean, Paul Volcker, before he passed away, even said that the current version of the Federal Reserve Bank, with the spending, the budget deficits, the amount of zero interest rate policy, all the stimulus and quantitative easing, he couldn't do what he got away with in the late 70s and 1980 with raising interest rates and keeping it there, created a mutiny on Wall Street. So there is no more real Paul Volckers anymore.
No, and it's unfortunate because there's a lot of people in macro like me and some others who think, the Fed didn't finish the job. And as a result, we're stuck with this inflation. And, we have almost bubble-like conditions in assets, risk assets, due to the fact that they've misjudged this economy in saying it was restrictive when it really hasn't been proven to be restrictive, at least not very restrictive. And so, no, there's definitely no Volcker on this Fed. They're very, very dovish. It comes across every day that they give a speech, and every time they have a meeting, they're dovish. So yeah, there's no Volcker in this
Yeah,
room,
yeah,
but it will be fascinating if to see if they do a U-turn, if the economy takes another leg higher, which I think it will. And it'll be fascinating to see how the Fed responds to that. Because if you want to be independent, that's when you'll have to do it. Because Trump will not want you to hike rates. He won't want you to slow the economy. That I think is the case, unless inflation is really inflaming away, which would lead to lower approval ratings for him because inflation was a big reason he won the election. Then he'll probably support rate hikes at that point. But if the Fed, hikes rates for, very little increase in inflation from here, I think Trump may have a problem with it. But we'll have to find out. We'll see how it plays out. We can make a mistake presuming these dynamics ahead of time because there's a lot of moving parts.
But it looks like these other central banks are in a rate cutting cycle, yield curve control, kind of debt monetization or quantitative easing themselves, maybe expanding their central bank balance sheets. So it's not just the Fed that's doing the policy. These other central banks already started, and I think a lot of the liquidity ended up in our capital markets.
Yeah, they're not doing QE, and I think QE is slowly being taken out of the toolkit because of the distortions that it created. So I think QE is in the toolkit if we go to the zero lower bound, which it doesn't look likely this cycle for most countries. But so I think QE is bad policy. They should get rid of QE. It should be a last resort measure for central banks when they're at the zero lower bound, don't want to go negative, and hopefully they don't go negative again. The ones who did. But we're not seeing any QE. But yes, I mean the Eurozone, Canada, New Zealand, Switzerland, Sweden, UK, they're all cutting rates. And the Fed wants to cut rates. I just think they're going to be prevented from going, too much further.
We'll have to have you back on in the near future for an update, Danny. I appreciate your time. I've kept you for over an hour. If my listeners want to check out your Substack or follow you on X, how do they do so?
So my Twitter handle is DannyDayan5, and in my profile you can see the link to it. Come join. Basically, I'm assessing the macroeconomy, global markets, different asset classes, as well as the trades that I do for myself are all in there. Option trading structures and things of that nature. So definitely come and join, and we have a great chat room that we use every day. That you can have a dialogue directly with me. Throughout the day as the markets are open. So happy to have more people come and join.